Solutions. So the topic for today in advanced FCCS is we'll be seeing the configurable consolidation second rule, that is your unrealized profit from stock, that is eliminate the unrealized profit from the stock. So let's begin. So I have taken one example. So you can see you have one holding company, one subsidiary company, and one consolidated, that is a consolidated entity. So entity might change, but example remains same with the numbers. So here you can see you have inventory amount for holding company. You just assume it with this is an holding company, this is a subsidiary company. So holding company shows an inventory. Holding company has purchased goods from an outsider. So the entry that holding company will do is inventory account debit to creditor payable account credit of 15,000. So means we have purchased the goods, holding company has purchased the goods from an outsider, so inventory will increase, and it has not paid the amount yet, so the credit we will be doing with the creditor payable. So 15,000 amount of inventory has been purchased, so debit 15 and credit 15. Then holding company has sold, has invested in subsidiary company 100%, and holding company is selling now the inventory to the subsidiary company of 20,000. That means, suppose if you can assume holding company has purchased inventory of 15,000 and it is selling to the subsidiary company the same inventory of 20,000. So the 15,000 margin that holding company has earned, it is within the intercompany margin, right? That is within the company only. So whenever we prepare the consolidated financial statement, so the inventory amount here, it will be showing of the 15,000 has been sold to its subsidiary company of 20,000. So this 5,000 we should get removed from this 20,000. So the inventory amount should stand as a 15,000 only. So that's why when you prepare the consolidated financial statement, this unrealized profit, because it is within the company profit, so and is intercompany profit should always get eliminated. And for this we can do this in with the help of journal entry also, but we'll be doing it with the help of while creating the configurable consolidation rule. Okay, so let's start. So we'll first see the transactions, what it has done, the holding company has done, then we'll see the transactions what subsidiary has done, and then we'll see what we'll see in the consolidated financial statement. So inventory, as we have seen, 15,000 he has purchased, that is holding company has purchased, so 15,000 has been recorded, and payable, creditor payable has been credited with 15,000. Then it is showing intercompany debtor. That means now the second entry shows that holding company has sold that inventory to the subsidiary company. So that means the 15,000 has been of the purchase amount was 15 and it has been sold to the subsidiary of 20,000. So what entry holding company will do, that is intercompany. Why it has assumed intercompany transaction is there, so to just notify that this is an intercompany transaction, not an transaction with an outside party, so we always denote, we use this intercompany to identify it. So it is saying intercompany debtor account debit. That means we have to receive 20,000 from the subsidiary company, so that subsidiary company has become the debtor because we will be receiving it. So intercompany debtor account debit 20,000, and we'll say now 20,000 will become our revenue, right? So that is in IC revenue, that is because this revenue has arisen because of the intercompany transaction, so IC revenue 20,000. And the narration, it is saying sold within the group to the subsidiary company. Okay, now the third entry what holding company has done is intercompany cost of sales account debit. That is, we are saying this is a cost of sales, this was the cost what we have purchased, so the cost at which you can sell the amount was 15,000, and inventory will be credited with 15,000 as we have debited with the 15,000 only. Holding company has purchased of 15,000, so if you want to reduce the inventory, you will reduce it by 15,000, and the remaining expenses we have booked of the 15,000 with the intercompany cost of sales, and the 5,000, that is the margin that you have the holding company has earned. It is booked in difference in the plug account, which is a markup, with the markup account of 5,000. So we have booked 5,000 markup. The holding company has booked the profit with 5,000. Okay, so if you see here the balance sheet of the holding company, inventory amounts stands 0 because first inventory was introduced, so we booked the inventory, then we sold the inventory within the to our subsidiary, so that means within the group. So inventory got reduced, so we credited the inventory completely by 15,000. So now the inventory stands at 0. Intercompany debtor standing at 20,000, that we have to receive 20,000 from the subsidiary, so that's why intercompany debtor. So we'll show the intercompany debtor of 20,000. So that will come in the asset side, so total of assets become 20,000. Now creditor payable, as we have also purchased on credit, so creditor we have in our book showing creditor payable of 15,000 because we have purchased the inventory of 15,000 and we need to pay 15,000 to the creditor. So that's why creditor payable liability will be standing in our books of accounts, that is 15,000 creditor payable. Then 5,000 markup is there, you can see that is a markup will stand in the retained earning, and this is a preceded account which is created in the FCCs under retained earnings account. So that's why it shows the differential amount, that is the profit earned in the retained earning account, and your assets and liability will be tallied. And from here also you can see that now it's saying we have to receive 20,000 and we have to pay 15,000 to the creditors. So the differential amount, which is nothing but the profit that the holding company has earned within the company, that is an intercompany profit. So which that is nothing but the markup. We'll denote it with markup and it stands in the under the retained earning account. All right, now we'll see for the treatment for the subsidiary company. So now subsidiary company has purchased the inventory. If we just talk about now subsidiary company, it has purchased the inventory of 20,000 and we are assuming that it has not sold the inventory yet to some outside parties. It has holded the inventory. So subsidiary company will enter inventory account debit by 20,000 and they'll say intercompany payable, right? Holding company has done, when a holding company has purchased the inventory, the similar entry what they have done is inventory account debit 15,000 and they were saying creditor payable as because they have purchased from outsider. But here the subsidiary company has to pay to the holding company, so that's why it says intercompany payable account credit to 20,000. So you can see this is the entry what subsidiary company will be doing, and we'll be seeing the balance sheet of the subsidiary company now. So you can see inventory account debit. So inventory of 20,000 will be coming under assets account, under the assets, and intercompany debtor that was there for the holding company, that is 20,000, that he was holding company shows the debtor and here it will show the creditor, right? So like here for holding company, subsidiary will become the intercompany debtor. But subsidiary company will say, like holding company will say my intercompany debtor of 20,000, but subsidiary company will say I have intercompany payable of 20,000. So that's what it is showing in the liability side, that is intercompany payable of 20,000 and inventory of 20,000. So no profit, nothing will be coming under retained earnings. So this is what the subsidiary company will be doing. Now we'll see the treatment that needs to be done for the consolidated financial statement. So here by creating the rule we can adjust the markup, that markup earned of 5,000 from the holding company's balance sheet. So what it in consolidated financial statement we'll be doing cost of sales account debit to inventory. So we'll reduce the inventory which is hyped now, because you can see within the company, holding company is saying I have debited the inventory of 15 and a subsidiary company is saying I have debited the inventory of 20,000. But the actual value for the inventory, because you cannot earn the profit, you cannot add the profit margin that you have earned within the company. So you have to remove that intercompany margin. So 15,000 is the actual cost of the inventory that has been held by the holding company. So we'll book inventory account. So we'll reduce the inventory by 5,000 because the subsidiary company has booked the inventory by 20. So that is overhead. Reduce it by 5,000. So that's why inventory account credit, and the 5,000 will be debited with the cost of sales. That is your, you can show it the expense side. Okay. So this is the entry that we'll be doing it to reduce the markup effect. And accordingly, the entry that I have done over here, we'll be creating the configurable consolidation rule. So let's begin. Under application, we'll go to the consolidation. You can even do the similar entry through journal, but for the sake of learning, as we are covering the topic of consolidation, configurable consolidation, so we'll be seeing how to do the similar entry with the help of writing the configurable rules. As I have already done this, but I'll, for the sake of simplicity, I'll create it again. I'll delete this. Okay, let's start. First, we'll create a rule set. So one I'll be creating with cost of sales. Second, I'll be creating with inventory that will be reduced with the markup. That is, if you remember the consolidated financial statement. Just a moment. So you can even write adjustment of unrealized profit. And you can say in description, it eliminates the effect of the markup applied on investment. Or inventories or stock sold to the intercompany partners. Intercompany inventories sold to the intercompany partners, and you can even write here intercompany inventories are reduced with the markup. reduced with the markup value, and the intercompany cost of sales are increased with the markup value. Now here under condition you can select advanced, and you can select the dimension as entity, attribute as current method, operator will be equals, and method will be holding. We are saying if entity's current method is holding, or so we are giving this condition if the entity's current method is holding or entity's current method is subsidiary, and data value that means the data source value, that is your total, we'll pick total input and adjust it here, does not equal it is not equals to 0. Okay, you can see now if your entity current method is equals to holding, or if your entity current method is equals to subsidiary, and your data value, that is your total input and adjusted, it should not be equals to 0. So this is the condition that we are applying to the logic. Factor, we can take it here as specific percentage, and here you can give the percentage 100. So we are saying apply this 100% on the markup value, whatever is the markup value, and remove adjust that from the unrealized profit or from the inventories that you have entered your, where you have entered your markup amount. So the data set, we are saying we pick the current scenario with the current year, for whatever year you are trying to write this rule for the current period, and consolidation property is taken as entity, total, currency as parent currency, and view we have taken as periodic. Now we'll pick some another, the remaining dimensions, that is we'll pick account. I'll define the member for the account as this is my markup account which is created. So my account for which I am trying to enter, because we want to remove this markup amount that has been entered by the holding company, so we don't want that amount in the consolidated financial statement. So account I have chosen here as markup. Second, I will take intercompany dimension, where I'll pick all the level 0 intercompany entities. So from function you can pick level 0 descendants, then I'll pick the third dimension as my movement. So we'll see, we'll enter at no movement the data I'll be entering for markup account, and at no movement. Then the next I'll pick data source. The value I'll be taking as data input. And the next I'll take multi-cap. I'll define the member value as local cap. So these are all my accounts. If you see, we have taken scenario as whatever is the current scenario, current year, current period. Entity also, for whatever entity you are trying to write the rule, so that is freezed. And the remaining three we have defined as consolidation as entity total, currency as parent currency, and you have view as periodic. And the remaining dimensions which are not there above in the data set we have defined here. That is, for account we are selecting markup account, intercompany as level 0 descendants for all the intercompany entities. Movement I have taken as no movement, data source as data input, and multi-cap as local cap. Now you can save and close. And this rule will apply to all. So now under it you will add now. If you see, what I'm trying to do is, if you come back here, you can see we are we are doing the adjustment for unrealized stock. Second is, what sub rule I'm adding to is, we want to reduce the inventory with the markup earned. So similarly I'll create one rule for that. We can say reduce inventory with markup earned. I am leaving the description as of now. Remaining everything will be same as a processing option. I'll be saying as add. I'll just click directly go to redirect my account members, or all the members. So markup account, if you want, you can this is my source account. Now if you want to redirect it to your target redirection, you can pick the same. So if you want the same, it will show you the same as source. Keep it as it is, or otherwise you can change it. Like I want to change it to markup account will be there with my inventory in the target redirection. So here I can choose this is my account. I want to adjust it with this target. If source is markup, then adjust it with this FC inventory. If intercompany, whatever is there in source, the same should be remaining in the target. Movement, I want here the movement to be changes in inventory. Instead of no movement for this particular inventory account, IC inventory, we want the changes in inventory. And for data source, we'll pick intercompany elimination. Yes, this is my member for data source. And multi-cap is local gap only, so we'll keep the same. All right, so Save and close. So this was the one that we have written, that is, if you drill down this, we are adjusting the unrealized profit, and under it we are reducing the inventory with the markup earned. Now we'll add one more to this adjustment of unrealized profit. So we have reduced the inventory with the markup earned. Now we'll write for cost of sales now. So cost of sales should be increased with the markup. And here processing option, I won't subtract. I'll go to redirect members. So account, now here for cost of sales, I want the account to be cost of goods sold. Here for because I want to adjust for this particular rule, markup with cost of goods sold. Intercompany will remain same. For movement, I'll pick again the changes in net income, as this belongs to net income portion. So and for data source, that is source data input, I want here intercompany elimination. And the local gap should be whatever is there is in source, same as source we want in target redirection. Okay, so save and close. So this is what you have created. So you can deploy it. Before deploying it, you can under application consolidation, first you define your ownership structure, enter the data, run this consolidation rule, and run the business rule, and check the result in your parent company. Sorry, we'll go to this manage ownership first. This is my company, that is under total company North America. So we want this North America to be reflected for FY16 January. So you can see here, this is my holding, this is my subsidiary. Holding has sold stock inventory to the subsidiary of 20,000 and earned the profit of 5,000, that is unrealized profit. LE1 US1 LE1 has booked in its books of account, for which we have read the configurable rule. So this is correct. Now before this, I would like to show you my input sheet where I have entered the details. So if you see, these are 4 columns. How this is bifurcated is, these first 2 columns is for LE1 US1 LE1, that is legal entity 1. If you compare this, these two are same. Now the difference arises, this shows that this is an intercompany transaction and this shows no intercompany. Similarly, this is US2, that is legal entity 2. In the similar way, this shows your intercompany transaction for legal entity 2 and this shows your no intercompany transactions. Alright. The remaining I have taken the same, that is entity input, data input, base level, entity currency and all. These are all my accounts and this is my movement. So I am entering at no movement. So my first account is markup. So if we keep referring this, so if you see, the holding company has booked markup of 5,000. So we'll come here and booked the markup of 5,000 for US 1 legal entity 1, and it is an intercompany transaction. Because of intercompany transaction, the holding company has earned the profit of 5,000, so we'll enter in the same way. So we have entered the markup of 5,000 and under no movement. Then second, holding company says I have a creditor payable of 15,000, which is a to an outsider, so which is not an intercompany transaction. So if we come back here, so you can see the short-term payable. Now that is a no intercompany transactions. For the LE1, you can see 15,000 has been entered under short-term payable. All right. Now come back here again. So we have entered these two. Now the second one is intercompany debtor of 20,000, because now holding company has sold inventory to subsidiary of 20,000, so that's why we holding company has to receive 20,000. So intercompany debtor of 20,000. So that means nothing but your intercompany revenue you will book of 20,000, and you will say intercompany receivable. Debtor is nothing but your intercompany receivable of 20,000. All right. Then you have intercompany revenue of 20,000 that we just saw, that is your intercompany revenue of 20,000. So these are all my intercompany transactions. Then you have intercompany IC cost of sales of 15,000, because we are saying we are booking this expense amount of 15,000, because originally the expense was of 15,000, right? So you can see the cost of sales is 15,000. That means we are saying we have earned the revenue of 20,000, but the cost of that particular inventory was 15,000. So the markup that is the net income stands to 5,000. You can see that is being calculated automatically, and the inventory has been credited of 15,000. So that is fine. We will not show it over here right now. So this is we have entered in US 1 legal entity 1, that if there is an intercompany or no intercompany transactions. Now we'll record for legal entity 2, that is coming to the subsidiary company. Now it says it has booked the inventory of 20,000, so here it will increase its inventory of 20,000. US entity has shown increase the inventory of 20,000. Then intercompany payable is of 20,000, that is now subsidiary company has booked that they have to pay to the holding company, so that will be an intercompany transaction. So intercompany payable of 20,000, so we have booked the same intercompany payable of 20,000. This is what has been booked by the legal entity 2, right? So all these transactions have been entered in the input sheet. Now we want this transaction, that is cost of sales, should be debited with 5,000 and inventory should be credited with 5,000, right? Because if you knock off here, inventory gets knocked off. You can see in the balance sheet inventory is 0, only it shows a debtor of 20,000, creditor payable of 15, so 5,000 is nothing but the markup. So we want this markup to be reduced and adjusted with the cost of sales, that is reduce a markup from the inventory. Now inventory is not 20, the actual value will be 15, so reduce from inventory and debit to the cost of sales, that is 5,000. Okay, so this is the input sheet. Now coming back to the application, this is we have done the manage ownership. Now under consolidation process, come to consolidated. Here under configurable consolidation, the rule that you have written is adjustment of unrealized profit. We'll deploy this rule. You can see the rule has been deployed, the rule that we just wrote. After deploying the rule, we'll run the console business rule. So this is my entity, the parent entity, that is your North America. Period is Jan, year is FY16, scenario is actual. Okay, so rule has been run. Now we'll check the output sheet. So I have prepared this, but this is the result that you will get it. So what I am doing it, I have the North America selected over here. I'm not showing any subsidiary or parent entity. that is a holding entity. I'm just we'll see that the consolidated financial statement, what is the effect of those markup account, revenue, cost of sales, cost of goods sold, short-term payable, effect of these accounts for the North America. So you can see the consolidation I have taken as one is your elimination, second is your entity total. What elimination needs to be done, you'll get it in the C column. What is the entity total, you'll get it here. So till now these two are same, okay, for North America. Now what is the difference between D and E is, here you will get for intercompany, you will get intercompany eliminations, but here you will get total data source, that is the sum total. All right, and everything is checked at the parent currency, because the data set we have set for currencies, entity currency as parent currency, and for FY16 Jan periodic actual remaining is same, and movement I have picked as total movement, and all the accounts are there. So what elimination is being done over here is, if you see, with the help of that rule, we want the cost of sales to be debited with 5,000 and inventory to be reduced by 5,000. So you can see cost of goods sold being added with 5 and inventory being reduced with the 5,000. Okay, so this is what we wanted, and this you can do it journal entry also, but we have similarly written the rule for this, and this is getting impacted correctly. And in entity total, if you see, now your intercompany inventory as for subsidiary company, it is standing here, it is 0. Here in subsidiary company, the inventory amount stands to be standing at 20,000, and I'm saying unrealized profit of 5,000 is being booked by the subsidiary company, so it needs to be removed. So that's why in intercompany inventory, it is reducing 5,000 from the inventory. Revenue of 20,000 needs to be removed. So IC revenue, which is being booked by the holding company, that is 20,000. There will be no revenue, so this should be removed here. So that's why it is saying minus 20,000 in intercompany, because everything will be booked in the intercompany elimination data source, because we are mentioning the member for data source as intercompany elimination only. So the cost of sales, it is being reduced by 15,000. See, the cost of sales is 15,000, that is the holding company cost of sales. So we are removing that. So here you can see the net income is nothing but 5,000. Intercompany receivable is minus 20, and short-term payable. In total data source, you will get everything. That is, short-term payable stand still at 15,000, which is correct. Because see, in consolidated financial statement, you will say creditor payable, that is your short-term payable of 15,000, which is showing correctly. You can see this short-term payable of 15,000, and you have inventory amount of 15,000. So the inventory amount of 15,000 at the consolidated financial statement, at all the top level for entity total, data source, parent currency, everything it is done as selected as top member. So intercompany inventory is 15, short-term payable is 15. And the cost of sales, that has been increased with the 5,000, that you'll get it over here. This cost of sales, that is your cost of goods sold, it has been increased with 5,000, and that is being adjusted as intercompany revenue cost of COS difference. So similarly that get adjusted over here. So this is how you with the help of writing configurable consolidation rule, you can check the result and how you'll be writing it. This is what we wanted, and exactly we are getting the same thing. Yeah, so that's all for today. We'll connect for the next topic in the next session. In the meantime, if you have any questions, you can contact BISP Solution. Thank you all for your time.